Investors, now that you have decided to do a reverse 1031 exchange, buy before you sell, how do you finance that initial purchase? Where is the money coming from? In this video, we'll talk about sources of funding for that reverse 1031 exchange purchase, who should not do a 1031 exchange, and provide you with some pro tips so that you can enjoy a smooth and successful exchange. Let's start with an example. Let's say that you own a $2 million apartment building and you want to sell that and exchange that into $2 million single-family homes. So you can start with a reverse 1031 exchange, buy before you sell, and then with the remaining proceed, do a forward exchange, sell before you buy. So reverse and forward. After you have bought that first $1 million single-family home, you have 45 days to identify the apartment building you want to sell, and a total of 180 days to close escrow on the sale of the apartment building and complete the reverse exchange. Then you have 45 days to identify the second $1 million single-family home you want to buy, and again, 180 days to complete the forward exchange for that purchase. Assuming you own that $2 million apartment building free and clear, and you pay all the transaction costs out of pocket, then after these exchanges, you will own these $2 million single-family home rentals free and clear after these exchanges. So that all sounds good, and overall benefits of a reverse 1031 exchange include, first, tax-deferred wealth building, just like with a forward exchange. With a reverse 1031 exchange, you can be more strategic, more opportunistic. You only have to sell after you have found and purchased the right replacement property. You don't have to sell first and then rush to find just any property within 45 days. And because of that, and if you're doing the more advanced strategies of combining forward and reverse 1031 exchanges, you can avoid competing against yourself in a tight seller's market or in a tight buyer's market. So that all sounds good, except if you're like most real estate investors, dirt rich, cash poor, where is that money for your initial $1 million purchase? Well, you cannot get a conventional loan for that initial purchase because the IRS does not allow you to do an exchange with yourself with a property that you already own. When you buy that initial single-family home on a reverse exchange, the title to that home will be held in the name of an exchange accommodations title holder, or EAT. An EAT is basically a temporary LLC to be owned and managed by the qualified intermediary on your behalf. Conventional lenders won't lend to such an entity. So again, where is the money coming from for that initial reverse 1031 exchange purchase? So here are some 6 possible funding sources for this reverse 1031 exchange purchase. Of course, you can always fund with your own cash as if you're lending money to this exchange accommodations title holder. Just make sure you're not selling stocks, pay the 35% capital gains taxes to federal and state, and then use that for the reverse 1031 exchange. That would defeat the purpose. But let's say if you do have idle cash in your bank account, you can use your own cash. If you have a home equity line of credit on your primary residence, and that's big enough for you to complete your initial purchase, you can use that to fund your reverse exchange as well. That is usually at an adjustable rate tied to prime. A third option is if you're combining forward and reverse exchanges and you're actually starting with a forward exchange first, then the sales proceed from that forward exchange from the property you have sold can be used as down payment on a reverse 1031 exchange for the property you want to purchase for your next leg of the exchange. So that's also possible. And then if you have a sizable stock or brokerage account, and the brokerage company allows you to lend against that brokerage account, then potentially you can get a line, get funding from that, that's another option. Usually they will give you 50 to 70% of the value of your brokerage balance. And with that option, that's also adjustable rate tied to prime rate. Option number 5, you can get private loans. That could be from your family and friends, or it could be from a private lender like Abundance. And we'll go into more details of the process when you're involving a private loan. And then, of course, you can structure a seller carryback on that property you want to buy. But honestly, most sellers would prefer a quick, clean offer. And even if they do agree to a seller carryback, they will likely want to be compensated for that risk and the complexity. So that may not be worth it unless the seller is a friend who's willing to do you a favor. Okay, let's say you have decided to use a private loan from Abundance for the reverse 1031 exchange. Let's walk through this scenario. When you buy that new property for your reverse 1031 exchange, the title is held in this newly formed LLC, also called EAT, and it's owned by the qualified intermediary. We would then do the private loan to this EAT and structure our loan so that we have the first mortgage on the new property and also a first mortgage on the old property, unless you already have a first mortgage on the old property. So in that case, we would be the second mortgage on the old property. And we would require you, the investor exchanger, to serve as a personal guarantee on this private loan. We would fund to escrow for this purchase. And when you close escrow, the clock starts for you to complete the sale of your old property within 180 days. When you sell the old property, the sales proceeds goes to the exchange accommodations title holder to pay down or pay off the private loan. So if in the earlier example, if you had owned the $2 million apartment building free and clear, then you would have completed that reverse exchange and paid off the private loan, the $1 million private loan on your first single family home purchase, and you will have another $1 million with your qualified intermediary to buy the second $1 million single family home. On the other hand, if you had a loan on your old property and you need a similar size loan on the new property to satisfy the 1031 exchange regulations, then you can pay down the private loan and convey the title of the new property from the temporary LLC back to yourself, the investor exchanger. And you would assume the title, you would assume that private loan after you have converted the title, and then you refinance the new property to a permanent financing if you need it. So this is all actually pretty simple if you work with a seasoned qualified intermediary and a seasoned private lender like Abundance. It just sounds more complicated because of the big legal words. Next, we want to step back and talk about when 1031 exchanges don't make financial sense and give you some pro tips so that you can get the most out of your exchanges and making sure it's a smooth and successful process. Before we do that, we will introduce ourselves. We, Abundance 99 Inc., are an independent mortgage broker for both residential and commercial loans. We scour the market to find the best mortgage rates and terms, ensuring you get the most competitive deal. And when traditional lenders fall short, our network of private investors offer flexible financing and options to suit your specific needs, such as we do on these reverse 1031 exchange scenarios. We will give you clear, personalized guidance and biased advice on the pros and cons of various loan strategies, helping you make informed decisions. As you can tell, we are real estate investors. We understand the unique challenges you face. We're committed to helping you navigate the complex world of real estate financing and achieve your goals. Now, let's get into the pro tips for a successful and smooth 1031 exchange. First, who should not do a 1031 exchange? Well, if you have capital loss carryover from other losses earlier, and that can be used to offset most or all of your capital gains, then you might as well not do an exchange at all and just pay the taxes and have the freedom to do whatever you want, whenever you want, with whatever asset classes you want. That is actually the biggest reason why you should not do an exchange. And in the case of a forward exchange, you really need to think about the permanent financing on the new property before you pull the trigger. So for example, let's say you have a $1 million debt on your $1 million debt on your $2 million apartment building, and you're exchanging into 2 single-family homes of $1 million each. Then at the end of the exchanges, you need to have $1 million debt on these 2 properties combined. So if you don't qualify for the permanent financing of $1 million or more because of credit, because of income, or because the new properties that you're looking to buy are not lendable, for example, fire damage, structural issues, or other financing issues, then you should not start the exchange. This is particularly true if you're doing a traditional forward exchange to sell before you buy. This is why you should talk with a seasoned loan broker first before you start that exchange. If you sell first and find out that you cannot get permanent financing on the new property, then you're either faced with an expensive private loan, or you may give up on the exchange and actually pay the taxes on your gains earlier. So that defeats the purpose of an exchange altogether. And number 3, in the case of a reverse exchange, if your old property cannot be quickly sold because it has tenant issues, structural issues, if it's a non-wordable condo, then you should not do a reverse 1031 exchange. You don't want to be stuck with 2 properties and a private loan if the old property cannot be sold. Finally, and this is very important, if you haven't spoken with a knowledgeable CPA, a tax advisor, or a qualified intermediary, you should really do that first before you start a 1031 exchange. That will save you a lot of time and headache. So then, let's say you are going forward with an exchange. Is a reverse 1031 exchange to buy before sell worth it? So yes, absolutely it is worth it if you have identified a good opportunity, a rare opportunity that fits into your portfolio. And yes, it is absolutely worth it if you want the extra time to buy or sell in a tight market. You don't want to compete against yourself. And third, if you have started a forward exchange and expecting that to close escrow, you have also gotten into a non-refundable, non-cancelable purchase transaction on your replacement property, but your sale is falling apart. Then to rescue that failed forward exchange, you may need to do a reverse 1031 exchange to complete the purchase first before you sell. And in that case, you would rescue the tax deferrals and then complete your sale as a reverse 1031 exchange. So these are 3 reasons why reverse 1031 exchange is worth it despite the cost of a potential private loan. Now, it is not worth it if the product that you want to buy or the property you want to buy has ample supply. So for example, if you're buying new construction, single-family homes in a subdivision, in a new subdivision, or if you're buying condos in today's market, there's ample supply of that, and you can easily find the replacement property. So the cost of a reverse 1031 exchange may not be worth it. And then, as we mentioned earlier, if you're doing a reverse 1031 exchange to buy before sell, but you're not confident you can sell your old property within 180 days, then again, you should not do a reverse 1031 exchange. Okay, now let's step way back and make some strategic decisions before you even start your exchanges. First, talk with a good CPA or a tax attorney a few years in advance. For example, if you have a property that has appreciated significantly and you want some cash out, if you do that as part of your exchange, you'd have to pay capital gains taxes on the boot, which is a portion that you're not exchanging. But if you cash out a year or 2 in advance, then there's no tax on that cash out refi. So once you cash out and you do that exchange, you will need to carry that loan forward or a greater amount forward, but still there's no capital gains taxes on the portion that you're cashing out. Another example, let's say you own the old property with a few partners in an LLC. If you want to go your separate ways on the next property, then you should convert the vesting from an LLC to tenants in common 1 or 2 or even 3 years in advance. Then you can exchange separately. Or some of you can exchange and some of you can just cash out without doing any further exchanges. These are things you should talk with a CPA or a tax attorney well in advance and plan it all out. And number 2, get your property and your tenants ready to sell. So whether you do a forward exchange or a reverse exchange or a combination thereof, you will be much better served by doing your renovations in advance, by doing your rent increases so that your P&L looks strong. You want to give tenants notices if they have been there for a long time so that they can move out and you can renovate in advance of your sale. There's a lot of things to do to get top dollar on the property you want to sell. So get those out of the way first before you start any exchange process. And then if you're selling multiple properties or buying multiple properties, sell and buy the most difficult one first, the most difficult to buy or the most difficult sell. Figure those things out in advance. Of course, you cannot always predict what trouble you will have, but at least if you plan ahead, you can manage the risks better and not risk a failed 1031 exchange. Finally, if you have a loan on your old property, and most of us do, then you should really get pre-approved for permanent financing on that new property, even before you buy and even before you start the process. You don't want to be stuck having sold your old property and not be able to qualify on the loan on the new property and be stuck with that failed 1031 exchange. If you have credit issues, get that fixed. If you have debt to income ratio limitations because you just retired or you took time off from work, then work with lenders where debt to income ratio is not used for loan qualification. If you need to have reserves ready, understand which lenders are lending and allowing retirement accounts for the type of as reserve for the type of properties and the classes of properties that you like. We Abundance are happy to help. So that pretty much does it for this video on advanced 1031 exchange strategies. Thanks for watching, and please be sure to subscribe and follow us for future videos. If you have any specific questions or suggestions for future topics, I'd love to hear from you. You can put them in the comment section below, and we will be sure to address them in a future video. If you have a speaker recommendation, we would love to hear that too. That would greatly help us in providing valuable content for our clients. And if you need a referral to a 1031 exchange qualified intermediary or to a tax attorney, send me an email or give me a call. I'm happy to help. Again, thanks for watching.